to our live stream, and we will be together for an hour. And usual structure, you can ask anything you like within reason, and it's got to be finance related, but ask me anything. It's the usual score. And we will be together for an hour. Myself, my dog, hello Ted, and if you are one of our supporters on YouTube, or if you do a super chat, we'll push your question to the front of the queue. And please do super chat, because obviously it helps us. And let me just start off with a bit of news, because obviously there's been a lot going on in markets, and particularly in the UK. We had a bit of a shock yesterday when Rachel Reeves appeared to be crying. In fact, she was crying during Prime Minister's question time. And it turned out it was a personal issue, but markets didn't like it. Gilt sold off, and we also saw sterling sell off, and that was largely a result of people panicking she was going to lose her job, I think. And you want to go downstairs? You jumped the gun there, Ted. That she's going to lose her job. Someone else would come into office which wasn't so careful about fiscal responsibility. There'd be lots of bond issuance, and as a result of that, yields kind of anticipated that happening potentially, and yields shot up and gilt prices fell down. Now, it was fairly short-lived, but we have seen a recovery in gilt prices and a fall in gilt yields over the last 24 hours. And Starmer's come out and said he supports Rachel Reeves. She's talked to the BBC, and everything seems to be fine. In fact, if anything, I'd say this shows how important she is, because she represents fiscal responsibility. And if there's any sign of her losing her job, markets seem to panic. So, if anything, this is good for Rachel Reeves. It shows she's human. She says she had a bad day, and when she has a bad day, it's in front of the telly. So everyone can see it. So, bit of a hiccup. But of course, if sterling weakens, that's going to be good for global index investors. So I've got to say, as much as I hated to see her cry, it did push up the value of my portfolio. Just saying. But that was the kind of market action in the UK. We're about a week away now, a little bit less, until tariffs kick in. President Trump's tariffs, reciprocal tariffs as he calls them, and that's going to potentially be a problem for markets, because there haven't been that many trade deals. The UK has, not many other countries have, so it's looking quite likely that we're going to see another potential risk-off move in equity markets if that kicks back in full force, because they are very widespread. The US is a very large economy which imports a lot, and so that could damage a lot of economies globally. So that's the kind of state of play, I'd say. US valuations looking very expensive now, and UK not expensive, I have to say. But the US back pretty much to valuations before the big sell-off in March, April. So very expensive. We're going back to the same leadership, very concentrated leadership of the S&P. So it is the Magnificent Seven again, which are pushing equity prices higher in the United States. So very much a replay of the rallies we've seen over the last 5 or more years. Growth, tech, AI is the narrative driving it, and we're pretty much back to where we were. So that's my summary of what's going on. I should also point out that we had a recent podcast, which is kind of relevant to what I was just talking about. And that is, let me share it. So obviously the podcast is called Many Happy Returns. And the title, which I blocked, the title is Neural Net Worth, What If AI Isn't a Bubble? So Michael's very good with the titles. That's what it's about. So we often try to test our beliefs and consider what could be true, what would the alternative truth be, or what's an alternative way of looking at valuations. And maybe it is the case that AI is so transformative that this isn't a bubble at all. And I came out recently and said this was a bubble, which is unusual for me. But what if it isn't a bubble? What if it is true that AI is incredibly transformative, and really we're just seeing the early stages of that transformation, and US stocks, which are currently hugely valued, have very high valuations, are valued at a high level because of good reason. So it's not a bubble at all, it's just pricing in a lot of upside in the future. So anyway, we kind of talk through that possibility. We also talk about AI. Michael and I also discuss, what you can and can't do with AI right now, because we're both pretty heavy users of AI. And I did used to work in artificial intelligence, I guess you could call it. When I was at Oxford, I was modelling language acquisition in kids, how kids learn language, and we use neural network models to do that. Very simple ones, very very small ones, perceptrons they were called, based on work by Minsky, McClelland, and so on. But anyway, that was kind of fun episode to do. I think you might enjoy that. Anyway, so that's our podcast, and we'll come on to your questions. We close that down and open this. No. There we go. Good. Right, so over to you for your questions, and yeah, please do super chat, and we will push you to the front of the queue if you do. So let me have a look. Emmanuel Marcoux says, how important is it to own your own home in retirement? Do people miss that in buy versus rent calculations? Well, I mean, a lot of the economic calculations are quite similar, whether you're in retirement or whether you're in the accumulation phase before retirement, which is that you've always got to think, if I have this huge sum of money, the lump sum, which I'm going to use to buy part of my house, because usually it's a leveraged investment, if I were to use that capital investing in markets, in capital markets like equity, given that the long-term return of equity is higher than it is for houses, almost in any country that's true, but certainly it's true in the UK and the US, then there has to be a pretty high reason. There have to be some pretty good reasons to prefer investing in the housing market. It may be that renting is very expensive in your country, so much so that it's actually cheaper to have a mortgage, and that has happened. Has happened in the past. So really, it depends on those variables. If interest rates are higher, clearly, then that's going to increase the cost of a mortgage, but usually it pushes up rents as well, because often it's the case that landlords buy with a mortgage, so that can increase your rent. So that can push up both of those numbers. But just remember that long term, usually you're better off, not always, but usually you're better off renting and simply using the capital to invest. But in retirement, clearly at that point, what you do want is to have liquidity, presumably, because then you can spend things. Whereas if capital's tied up in your home, that's money you can't spend. So I think for some people it would make sense to move into rented accommodation. Psychologically, a lot of people don't like that, but I think that's certainly an alternative for people. But there is no easy answer for whether it's better to buy or rent, and I think psychology is such a large part of it that it's the economic calculation is a fairly straightforward one, and it's really about relative return, but the psychological considerations are much more difficult to gauge. It really depends on you. But yeah, I think for a lot of people it would actually be better to rent in retirement and just have the capital which you can then spend. But clearly, if you're worried about inheritance for your kids, then yeah, maybe you see your house as a kind of store of capital for the kids to get after you die. I know many people do see it that way. Next question is from, let me just see if there are any super chats before I go on. No. Is CSH2 taxable as a capital gain rather than income tax? So CSH2, if you're not aware of it, is an accumulation money market fund which is available in the UK. If you're on an ETF only platform like InvestEngine or Trading 212, a lot of people use it because it is probably the largest money market fund. There are others, but it's an accumulation money market fund. So you don't have to think about reinvesting the dividends. It tends to pay out a little bit more than the SONIA rate, the Sterling Overnight Index Average rate, which is why I think people like it. It does have a lot of derivatives in it. It does take the AONIA rate, the European rate, and then swap that into sterling, and it picks up the interest rate differential with the swap which is embedded within it. So I think it is a very complex product. So I think a lot of people don't understand it. And you'll see it's got a collateral basket because of the stocks, which makes it even more complicated. You often see, if you look at the collateral basket, it's equity, and you're thinking, well, why does a money market fund have equity? Well, it is just a collateral basket that goes inside the fund. So, but the question is about tax. Now, because it's an offshore reporting fund, a UK offshore reporting fund, it's based in Ireland, I believe. Because of that, you have to pay something called excess reportable income. And that means that any dividends which are paid, even though it's an accumulation fund, they are treated like income. And that means that you have to report it as income. So that does have to be reported. So if you have a large holding in CSH2, you do have to report it on your tax return, your self-assessment, and you have to declare that income, even though it's an accumulation fund, which seems odd. But anyway, if you are a member of our community, we've got a whole explainer, which I did, I think it was 2 weeks ago, on excess reportable income. And I kind of went into all the details, which form you have to fill in order to report it, how to calculate it, what reports you want from your broker, and also how to take those report elements and put them into your self-assessment. But yeah, I think for the sake of a YouTube live, I probably won't go into that, but it is available for our members. And if you did want to join our membership, it's pensioncraft.com/membership. Probably worth mentioning. Right, so that's another question, and still no super chats. So if you could super chat, that would be great. Question from Don Miles, who says, "What do you think of the Avantis AVSG fund?" I have no idea what that is. So let's have a look. As much so you can see how I read fund fact sheets as anything. Here we go. So it's a global small cap value. Ooh, small cap value fund. How exciting! There's only one other I know of, and it's an ETF. So here we go. That's the fund itself. Now, where does this trade? So the first thing I'll look at is where does it trade. So it does trade on the London Stock Exchange in sterling, with a ticker AVSG, so that's good. It also trades in dollars, not so interesting for me, and on the German Xetra exchange in euros, of course. Okay, and it gives you global small cap value exposure. The reason why I'm kind of excited about that is because small cap value is typically seen as something which is historically, at least, generated very good returns, particularly in the United States. If you do these back tests which look at these factor tilts and look at which factors have performed the best, this one wins hands down. Over the last 2 decades, not so much. It's not done very well at all. But historically, small cap value has been just an unbelievably good performer. There are various reasons why people say that now that premium that you get for this has diminished. Maybe it's because, who knows? Who knows what the reasons are behind it? But certainly recently, small cap value is not done so well. But who knows? Maybe there'll be a resurgence in this factor tilt. So remember that you can't recreate a small cap value tilt with a small cap fund alongside a value fund. These funds, they buy the intersection of those two circles on the Venn diagram. So the stocks they buy are both small, the market capitalization is small, so these are early stage companies perhaps, or just small companies which have stayed small, and at the same time they're cheap. So relative to their book value, their profits, the price is fairly low. So that's what small cap value is. But as I say, it's quite exciting because I haven't seen one of these before, and I'll certainly be adding that to my cheapest funds list. Let me just make a note for that. But that is interesting. Let me just make a note of the URL for that. But we do maintain this kind of cheapest funds list for our members, just so that they can keep track of what is cheap. And we're also adding stuff to that. So for example, we're adding a cheapest platform, ISA platform, cheapest SIP platform to that, because we think our members would find it useful. And we don't have that on the website currently, but I think it would be useful for members to have that. But let's have a quick look at the contents of this thing, because it might be interesting just to see what the top 10 holdings are, if we have it. Yeah, so it won't be stuff we'd have heard of because they're small, cheap companies. But you can see there's a bank here. There's Radian Group, I've never heard of. Learcorp, I guess they make the jets. Calmain Foods, yeah. So stuff which is quite exciting, stuff you wouldn't have heard of. I wonder if they've got a breakdown by sector. No, but you can drill into the actual individual holdings there. And I hadn't heard of Avantis either, which is interesting. Maybe they've just started creating funds for Europe. But interesting. Thank you for sharing that, actually. I hadn't come across that. Who was that? That was Don Miles. Thank you, Don. We do have a super chat now. Thank you, Mark. So Mark Evans says, hi, Ramin. Do you think markets would react to a Reform general election victory? Good, bad, or indifferent? Well, there's still quite a long time before the next election. And I do follow this website, which is amazing. I love the graphics on this website. Let me share this with you. So it's called Election Maps UK. And you can see that what they do is they look at polls and they kind of do a nowcast of what the vote would be at any point in time. So you can see that at the moment, Reform would have 316 seats. Labour would be way in second place with 142. Lib Dem 76. And the Conservatives, effectively, according to this poll, are finished as a party. They've only got 31 seats. They're getting close to where the Green Party has been until recently. And if you look at a map of the UK, generally Labour is still marking the capital red. But if you look at where Reform is doing particularly well, it's in the less prosperous regions outside the southeast. So southeast is mostly, and southwest and south central is a lot of Lib Dem. Certainly where we live in Buckinghamshire is Lib Dem and likely to remain so. Labour in central London and a kind of smattering elsewhere. Here you can see Hexham, also Labour, according to this. But of course this is all based on forecasts. And if we look at Scotland, it's SNP and Lib Dem for, where is that? Caithness, Sutherland and Easter Ross. So I think that's pretty surprising given the size of the move, right? So certainly based on polls at the moment, it does look like it's going to be a landslide Reform victory. Now, what does that mean for markets? Well, as always, we saw what happened when Rachel Reeves cried. Markets are very, very concerned at the moment about spending. Now, if it was the case that Reform got into power on a ticket where they said they were going to cut spending and not cut taxes, that would be seen as positive by bond markets, potentially also by the currency market, but really that's what the market's looking for. Some kind of fiscal discipline, at least a plan for growth. If there's too much austerity, of course, that usually holds growth back. So this kind of, you have to tread this kind of very narrow path between spending too much as a government and not spending enough. And the concern with Rachel Reeves losing her job was that Labour would spend too much and wouldn't even consider cutting back on spending. But the real question is the Reform Party going to be a mini US Republican Party? In other words, will they be completely focused on cutting taxes at the same time as having austerity? In which case it wouldn't be so bad, at least in terms of the bond market view, because at least they'd be cutting back on spending. But remember, if they cut taxes, they have to balance the books. And they're not going to inherit a situation which is much better than what Rachel Reeves has. So really the options are increase taxes in order to increase revenue. If you did want to cut, if you did want to carry on spending, or either that, or if you did want to have tax cuts, you're going to have really severe cuts. And if you look at social services in the UK, for example, they're cut almost, they've been very severely cut. So there isn't a lot of margin for cutting after many years of Conservative rule. So I think that's the problem. So I'm not convinced that it's going to be easy for whoever is in power, whether it's Conservative, Reform or Labour, for another term, which is looking unlikely. So I think markets will probably initially be optimistic because they'll talk about austerity. But then when they actually get into power, when rubber meets the road, I think that's going to be a problem. They haven't ruled before, ever. And, I don't think they've got the experience in terms of politicians in order to do a good job. So it's going to be a very rough ride, I suspect. But look, who knows? Who knows? This is currently about 4 years away, so we won't have to worry about this for a while. But I think those are the variables markets will be looking at. And of course, foreign policy, and what are they going to spend the money on? So if it is just a mini Republican Party, a mini MAGA party, the MAGA version, a version of UK MAGA, if you like, then I think markets would have a bad time of kind of digesting that, because a lot of those policies are not particularly market friendly. But who knows? Next question is from also Super Chat. Thank you very much. C. Noctiluca. Very good. Those noctilucent clouds you're referring to there with your handle. I love it. Who says, a Mundi Prime all-country world, so that's PACW, has no accumulation version. Kid says dividends are annual. Many companies give dividends quarterly. Are you not losing on potential compounding due to this retention of income? Yeah, you are. So I think the thing is, if you have an accumulation fund, but just to kind of explain what you're saying in case everyone's not on board with that. So let's imagine you own a portfolio of 1,000 stocks in a global index, or 3,000 stocks in a global index. If you've got an accumulation fund, as a fund manager, what you could do is, as every penny of dividend is paid, you reinvest it into some of the stocks in the index as soon as you receive it. And of course, institutional fund managers can do that very cheaply, very efficiently, especially for the large caps. Now, if you've got an income fund, let's say it pays annually, well, by retaining the income over the course of an entire year for all of the dividends which are paid for all of the stocks in the index, that's money which you're not investing and which you don't have any benefit of. So that's why if you have very infrequent dividend payments, it hurts your total return if you would have reinvested the dividends. So yeah, I think you're exactly right that if it does withhold dividends, or if its payment frequency for dividends is not particularly high, yeah, that means that you lose out on compounding. So that's why I always like accumulation funds, because I've got fair old confidence that they're reinvesting fairly rapidly back into the index. You never really know. They never say, which is annoying. I would like to find out, particularly for some of the big index funds globally, how they do it, how they reinvest, what they reinvest into, what are the rules. They're probably not going to be very forthcoming on that, but I would like to speak to a fund manager about that sometime. Vanguard would be a good one to talk to, because they probably do something quite investor friendly, put it that way. So they'd probably be willing to speak about it. But yeah, you're absolutely right that PACW is an income only one. It's an income only fund. Unfortunately, it doesn't have an accumulation version. So let's have a quick look at that actually. Again, I think we definitely got it on our cheapest funds list, because I remember adding it. Let's have a quick look at it. So this is what our dashboard looks like. Let's go to launch the trackers, and we'll look at cheapest funds. There we go. So let's choose UK. We also have European and US cheapest funds. I just added some for a US member actually recently. That was something they told me about, the Fidelity Zero funds. But let's look at global equity. Yeah, here we go. So PACW, you can see that's at the top, and it is an income fund, right? Inc. And it doesn't have an accumulation version, unfortunately. It's a pity, because that would be a great fund. It would certainly be the cheapest global accumulating equity fund, and I would have used it in my latest video, which was about that, but it didn't make the cut, obviously. I think I did talk about it, but it's an income fund, so I don't use it. I use this one, which is the State Street one, ACWI, on Invest Engine, because the fee for that is a little bit higher. It's 5 basis points higher, but it's an accumulation fund, so I don't have to worry about the reinvestment. But there we go. I think a lot of people, I think because it's such an important part of your portfolio, the global equity part, that it really does pay to make really careful selections when it comes to choosing that global index fund. But that's the one I'm currently using anyway. I did learn something tonight. I didn't know about that Avantis Global Small Cap Fund. Thank you for that. Right, how are we doing for time? Half time, so I think I'll summon my puppy upstairs and offer him some of his special burger treats. So, what have we got? Here we go, burger treats. He only gets one of these a day, so this is a special treat. I also was in London today. We had a kind of Finfluencer meeting, and here we go. This is his burger treat, and he got a bit of bacon because we went to the Ottolenghi restaurant in central London. Oh, look at this! Look at this! Oh, Ted, I love these. I usually feed him one of these each morning, which he loves. You gonna stand? You have to work for it, Ted. You have to... Oh, no. Don't put your paws on me. Oh, very good. Standing. Oh, no, it's not finished. One more. Good boy. Go on. Biltong, you go downstairs. There we go. He's a happy puppy now. Very good. Right. Back to your questions. Got to say that Ottolenghi restaurant was very good. The shakshuka looked amazing, but I wasn't brave enough because I had a white shirt or a blue shirt, so I didn't want to risk shakshuka. Okay. Oh, another super chat. Thank you for that. It's probably for Teddy, it usually is. Oh, that's interesting. Okay, so this is from ENP. Thank you very much, ENP. It's a super chat, and they say, it seems to me that understanding equity markets is like cosmology, and understanding bond markets is more like quantum physics. Oh, that's brilliant. Yeah, if you've done a physics degree, you kind of get that. So, how would I describe cosmology? I mean, cosmology was kind of fluffy and interesting with a few equations thrown in. Um, Although there was a really cool proof about how much hydrogen there was in the universe relative to helium. It's a 1 to 4 ratio, and it kind of explains why, if the universe expands at a certain rate and then cools at a certain rate, you'd expect precisely that ratio. And that was pretty cool. So there were bits of cosmology that were really cool, and big questions like, is the universe open or closed? But really, that's a question about how much mass is in the universe and whether we have this repulsive force. Interesting stuff, but a bit fluffy and hard to prove. But things like quantum physics, really weird stuff, right? So quite mathematical, intuitively almost impossible to visualize. I mean, how can a particle be a wave and a particle? Is it a billiard ball or is it a wave? What is it? So very difficult to understand intuitively. Mathematically elegant, beautiful, like all of physics, but very difficult to understand. Yeah, so that's why it's like bond markets, right? Because quantum mechanics, quantum physics, kind of like bond markets, and cosmology is kind of like fluffy, simpler, like equity markets, right? So I think that's quite a good analogy. I love it. Yeah, I like that. Almost as good as the PensionCraft thing, which is that gilts, long duration gilts, are crypto for old men. I thought that was particularly apposite. Not just old men, maybe old women as well. But I just think that, yeah, yeah. Anyway, so next super chat, another one. Thank you very much. And this is from Simon Scott, who says, what's your outlook on corporate bond funds, specifically BIPs and MGCI, neither of which I'm familiar with. So let's have a look at that. But, just broadly, at the moment, I think it's still true that currently spreads are very tight for bonds. And that's true whether you look at the US, whether you look at Europe. We've just had a deluge of issuance in Europe where lots of corporate bond issuers, which are the companies that borrow in the corporate bond market, traditionally the European corporate scene has been very much dominated by bank lending, whereas in the US a lot of companies get funded via the bond market. Now that's shifted, and it's shifted a lot recently because as people have been slightly more concerned about US assets due to economic policy and the value gyrations in the dollar, the weakening of the dollar, people have focused more on European corporate bonds. And so that means there's a huge appetite for European corporate bonds. So there's been a lot of issuance in Europe. There was a story I was reading about this in the FT today. Now, of course, if there's a big demand for the paper, that's going to push up the prices and push down the coupons. So spreads will tighten. So you're not being compensated as much because there are people clamoring to buy this paper, and the issuers don't have to offer such a big coupon to buy their bonds. But let's have a quick look at those two. So the first one, BIPS, looks like it's this Invesco bond income plus. So I wonder what the income plus is. Let's have a quick look. You often get quite interesting funds from Invesco, so let's have a read of what this does. So high level of income and capital growth to investors, accesses the high yield bond market, diversified across countries and industries. So it sounds like a global bond fund. Okay, global high yield bond fund. So the yield is 7.1%. Oh, isn't that high? I wonder why. Well, it's because it's low quality credit. So a big chunk of that will be the risk-free rate, which is now higher, and then laid on top of that will be a credit spread to compensate you for the credit risk of the companies. So is this actively managed? Let's have a look at the expense ratio. Do we have it? And that should tell us whether it's actively managed. Let's see if we can find the KID. So this is the key investor information document. And what do we know? Not much from that. Can we see what's in it? So the managers. So I'm guessing this is an active fund. If it was a passive fund, you wouldn't see all these people listed on the page. So it's probably actively managed. I'm guessing the expense ratio is fairly high. High yield expense ratios do tend to be quite high. Premium. What does that mean? Monthly fact sheet, maybe. Launched premium. I'm guessing this premium is, oh no, here we go, ongoing charge 0.87, right? So this thing is expensive. That's probably largely because of the active management. And so they want capital growth, high income. So yeah, at the moment, spread's pretty tight. So let's go back to the trackers and let's just have a quick look at what the spreads are right now. Because this is often quite difficult to find, which is why I added it to the trackers. So this will come under bond markets. That's the UK gilt yield curve. So you can see that the risk-free rate, which is what you'd get for one of these gilts, it's not risk-free of course, but it's called a risk-free rate for any given maturity, is now pretty high. So if we go to the 20-year point, it's about 5.3. This is post Rachel Reeves Tears, of course. And it's as of yesterday's close, so it still factors in the tiers. And then the 10-year is at about 4.6. So let's look at the high yield credit spreads. And I've got two of these. I've got Europe and the US. So currently we're looking at 2.9 for the US, 2.9 percentage points additional spread due to the credit risk. And for Europe, something comparable. I'll just zoom in. For Europe, 3.1. So you can see this huge, well, quite large blowing out of spreads as people were worried after Liberation Day. And then it tightened again as people kind of forgot about that. No longer pricing any risk. And now I suspect from next week onwards, when they kick back in, if they kick back in, those could blow out again. So a lot of complacency in this market, I think. If we look at the sell-off in 2020 with COVID, you can see that the spreads blew out hugely. So for the US, blew out to 10.9 percentage points, and for Europe, 8.9 percentage points laid on top of the risk-free rate, which at that time was very low. But of course now the risk-free rate's higher, but the spreads you're layering on top, very small if you compare it to history. I mean, you seldom see spreads this tight. And usually that comes just before a big shakeout. But not always. I mean, there can be long periods when spreads are pretty tight. So not a lot of compensation for taking that risk. So that would be my concern, I guess. Another one, M&G Credit Income Investment Trust. So another, now this one's closed-ended. So if you are buying illiquid things like corporate bonds, which are high yield, not a bad idea. Because remember that with a closed-ended fund, the capital never changes. If someone buys the fund, they have to buy it from one of the existing owners. So it is a closed capital fund. I'm guessing the ongoing charge for this one, 1.3, very high. This also, I'm guessing, has a lot of junk in it, junk bonds. Does it have a list of what's in it? Sometimes they give you a kind of credit rating breakdown, but not so on this one as far as I can tell. That would have been useful. No, that's not great. Could do better, M&G. No, I can't see it here. But I would expect to see something. Give me a clue. Oh, look, that's probably the manager, Adam English. Doesn't he look jolly? I'd look jolly if I was making 1.28% ongoing charges. But look, let's just see if we can find what's in the fund. So we've got a sector breakdown. Do we have... Okay, we've got a country breakdown. So Europe makes up 50%. UK makes up 45%. So it's mostly European with a smattering of US, which may just be US issuers which have issued in the UK. But there we go. Duration is fairly short. You kind of expect that with high yield. So you're not taking a lot of duration risk with this thing, but you are taking obviously quite a bit of credit risk with it. I wonder if they've got a rating breakdown. Can we tell from what they've got in there? Difficult. But if you look at the sector exposure, you've got asset-backed securities, real estate development and management, 8%, banking, non-agency, CMBS. So there is a US stuff in here as well. But it's pretty hard to tell the credit quality of the stuff in there. I'm guessing it's fairly low. Otherwise the yield wouldn't be high. Does it have the dividend yield? Yield to maturity 7.3, yeah. So it's got a lot of lower quality credits in there. It wouldn't have such a high yield if that wasn't the case. But yeah. Would I buy it right now? Probably not, because you saw how tight those credit spreads are. If there is a weakening of the global economy because of tariffs kicking back in, and remember, we're at the very beginning of this presidency, so it's going to be a rough ride when it comes to trade, and that's going to be a rough ride economically. And that means that there could be a shakeout in credit, there could be the potential for a recession in Europe, and if that happens, then credit spreads widen, default rates increase, losses increase for these credits. So that would be my concern. So the time to buy corporate bonds is not when spreads are super tight. It's after they've blown out, because that's when you get the real bargains. So that's when I'd consider these two funds. But look, keep them on your radar. I call it my market crash shopping list. So I have a list of things which I like, but which are currently too expensive. And in the case of credit, what that means is that the spreads are tight. That's what expensive means. When the spreads blow out, when there's a crisis in credit, that's a great time to buy, because then you get on board, you buy the fund at discounted prices. And if it is a diversified fund, it always recovers. So that's when I'd find those interesting. But at the moment, I'd probably give them a miss because spreads are so tight. But thank you for those two funds, interesting ones. I've not come across either of those before. Probably go for a passive one. But there we are. That's just me. So how are we doing? We've got 15 minutes. Another sweet Fanta. And back to your questions. Thank you for those super chats. That was quite a funny one with the quantum mechanics and the quantum physics and cosmology. I like that. It's interesting. I mean, when you work at an investment bank, if you speak to the fixed income people, they're always being unpleasant about the equity people. You know, they always say, oh, they're always optimistic about the markets because, you know, equity investors are generally quite optimistic. Credit investors are quite miserable. And they always say that equity is too simple as a product. As a product, you know, the price goes up and down. That's it. Whereas with bonds, you've got to think about the second dimension, which is maturity. And the maths is more complicated. You have to understand how to price it. You can price things with yield, or you can price it with, you know, the price of the bond. But yield's a much better comparison tool. So people say it's, you know, fixed income investors always think they're a kind of cut above equity investors, which I'm not sure is true. Oh, that's nice. There's a new theory that says our known universe is inside a black hole. Trend board. Interesting. There's a very interesting book. It's a science fiction book. Who was it by? I think it was Greg Bear, where he was talking about a kind of stacked universe thing, where every universe gives birth to the next one. I think it was Greg Bear. Maybe not. Maybe it was Brin. It doesn't sound like David Brin. It started with a B, but the idea was that each universe gives birth to the next universe, and they actually have this ability. I think it was called Cosm. That was the name of the book. Since we're on the subject of cosmology, Cosmonovel. Yeah, it's Gregory Benford. Sounds like him. Great book. Loved it. Anyway, we digress. Hedge fund says, I gave up on bond funds a year ago. Better using cash as a safe haven. Yeah, look, if you don't want duration risk, cash is zero duration bonds, effectively. So that's the way I think of it, at least. And if you have a money market fund, that's like a zero duration or a very short duration bond fund. And at the moment, you're still getting a reasonable rate for SONIA. So SONIA's now obviously lower than it was because the Bank of England's been cutting. I think you're getting about 4.25% for SONIA. So if you own a money market fund right now, let's just get a quick read on the Bank of England's SONIA rate. You can always look it up on the Bank of England's website. Just Google SONIA Bank of England, scoot down to the bottom, have a look at SONIA, and let's look at the chart. I think currently it's around 4.2, maybe a little bit less. Yeah, so it's 4.22%, which is what you'll own if you've got, say, CSH2 or Royal London's money market fund. That's what they generate right now. And there is a kind of compound index as well from the Bank of England, which is what you'd earn if you owned one of these accumulation money market funds. So you've got the accumulation one. No, can't find it. It's here. SONIA compounded index. So your accumulation money market fund the price of it would look a little bit like this. And you can overplot one versus the other, and they do match quite closely. Let's see if we can just quickly pull the graph up. Quickly is perhaps the wrong word to use. Here we go. So that's what it looks like. And the gradient here is the SONIA rate that we saw previously. So it would be increasing at a rate of 4.2%, 4.21% per year currently. And as the Bank of England cuts, the gradient kind of flips down a little bit, it reduces. So the gradient is SONIA, right? But yeah, I can see why people kind of don't like duration, because when you buy fixed income, you don't like to think of it as risky, but of course it is. Duration risk is a real thing, and people generally don't understand duration risk. I think that's fair to say. Jason S says, we now know the universe is flat to a very small tolerance. Cosmology has come on. Very good. Okay. Because there was talk about in cosmology about the shape of the universe. What topology is it? Is it a torus? So if you kept on going forever in one direction in the universe, would you come back to where you started? That's a fascinating question. But certainly according to Jason S, that wouldn't happen. I chose a distribution ETF in my general investment account, says Julian Dickinson, to allow me to determine my dividend taxes. Is this correct? Yeah, I mean, certainly for pension crafters, what a lot of them do, because of excess reportable income, people will go to huge lengths not to have excess reportable income. So they don't buy funds outside an ISA or a SIP, particularly income funds or accumulation funds. Accumulation funds is where it's complex. But generally, if they do hold ETFs, UK reporting funds, they hold them outside, and they're holding them outside an ISA or a SIP. They go for the income version, just like you, because that separates out the income from the capital gain very clearly and makes the tax return easier to fill in. So I certainly know other people do that. So that's interesting that you do that as well. Yeah, excess reportable income, if you can possibly avoid it, I would. It's just a nightmare. Even if you've got an accountant. But you just have to keep very good records if you have an accountant, and just pass it on and just hope they get it right, because you get quite a big fine if you don't report it correctly. Right, and then Kieran McConnon says, only just come online, but why is the mega bill, is that the big beautiful bill, not top of everyone's priority? Is this not going to cause a spike in yields now it's passed? How could it already be priced in? Well, look, it's not a surprise. People have been seeing this for some time, and it looked like it was likely it was going to get passed. It is getting pretty close to the wire. I think it may get watered down in its final version, but certainly it's been passed, but not in its final form, is the way I understand it. But is it a problem? Yeah, because if you look at what the CBO is saying, the Congressional Budget Office, which is this neutral body which looks at the fiscal plans and looks to see what effect it will have on the debt to GDP ratio. Think of it like the debt police. The CBO is very concerned about this bill, and they are saying that it's going to add considerably to US debt. And it seems as if the Republicans don't get it. They just refuse to admit that if you cut taxes but don't cut spending as much as you're cutting taxes, it's going to add to your debt, when of course it is. If you're assuming that it's going to generate growth, which is what we've heard for so many decades now, but seldom seen materialize, in fact I think never, if that's your assumption, then you're kind of deluding yourself, and the CBO has not been deluded. So I think that's the problem. If they have a big fiscal deficit, the debt to GDP will continue growing. There's a lot of leeway for that debt to grow further. I think it could get to about 170% of GDP without it becoming unsustainable, according to a paper I saw by Vanguard. But so we've got a long way to go from where we are today, which is about 120% of GDP. But once you cross that threshold, you can't grow your way out of the problem and reduce your debt to GDP by increasing growth. So that could be hugely problematic for the US, particularly as it's got such a large treasury market. If that becomes unsustainable, and the bond vigilantes step back from it, and yields spike, and debt servicing costs increase further, well, firstly, it's going to have huge negative economic consequences for the US. If they do default in all but name, then again, that's going to cause a repricing of risky assets all over the world. It's a huge deal. So I think that's why I think you're right that there isn't enough focus on it. And if you look at US valuations, it's as if there isn't a problem. And if you look at US credit spreads, again, it's like there isn't a problem. But there is a problem, and it has to be addressed. I think a lot of the hatred of Rachel Reeves has been because she is so tough on the fiscal rules. And whether you like her or you don't like her, I think bond markets clearly like her because they don't want to see a huge amount of issuance and unsustainable debt. So it would be refreshing if we did see something like that in the United States. But we don't see it from either party at the moment. And then 6 minutes to go, 5 minutes 30 seconds. So I think we've got time for 2 questions. Oh, Jason says it's Euclidean, right? So that means it's Euclidean space is just like, where you have Pythagoras' theorem working. Interesting. We're talking about the structure of the universe again. Oh, lovely to see Laura. Not my partner, Laura. Oh no, love to see Lynn there. So Lynn is one of our frequent flyers. She's often on the live streams. She says, "Evening, Ramin and Laura and Teddy. Sorry, we're a bit late." No worries, Lynn. And let's see if we can find one. Oh, another bond question, surprisingly. Okay. Let's see if we've got any super chats before I go on, because I've got form for that. Okay, no. So is Gil S UK 10-year treasuries interesting enough now? Well, certainly a lot of fund managers were buying yesterday, which was interesting. So this story from the FT, I just saw it just before I came on. BlackRock and Schroders were buying gilts during the market slump. But then, I looked at the yields. So this is what happened to 10-year yields since, when does this go back? This is July the 1st, I guess. So this is Starmer refusing to back Reeves, and then yields blow out, the 10-year yields, and then at the open, yields rallied again, right? So, but if you actually look at a 10-year gilt, if you look at the price of it, it's not quite so clear cut. So this is a 10-year gilt. So this is the bond called T35. It matures in 2035, and it's a regular 4.5% coupon bond. And you can see what happened. This is the big sell-off that we had with the Prime Minister's questions. Remember, yields and prices go in opposite direction. So if the price is falling, the yield's increasing. So that was the yield spike there, the price fall. And then at the open, you can see it snap back up a bit. But it's still not quite to where it was, right? It's still, 1 percentage point lower in terms of price. But, yeah. Interesting. Back to your questions. So would I be buying now? Yeah, I mean, if I wanted to buy gilts, I would have bought them. I don't really need it as part of my portfolio at the moment. I've still gone, for equity, heavily into equity. I mean, my core is still in a single global equity fund, and I don't want to buy more bonds. So I didn't buy any. But if I did want to buy some, I would have. Right, that would have been a good opportunity. What else have we got? One more question and then we'll end. Will there ever be a circumstance where you might consider an active fund that outperforms a comparative passive fund and has done for a few years? Right, so I think the relevant thing there is a few years, because what happened in the past isn't always a good guide to the future. And what you find, if you look at this persistent scorecard from S&P indices, what it shows is that the funds which outperform, that outperformance doesn't persist, which means that if you choose funds based on the previous few years' outperformance, that often doesn't predict outperformance in the future, which suggests that there's a degree of luck in the outperformance in the first place. But look, if there is an active fund which I own, which is the Scottish Mortgage. So that's an actively managed fund, but that buys things which I couldn't buy myself in passive form. So it's a growth approach to investing. It's kind of growth oriented. It's got slight leverage in it, but it buys unlisted stocks like SpaceX and a whole slew of others. So that's why I think it's kind of interesting. And the fee's not particularly high. That's another big consideration for me. So there just aren't that many active managers where I listen to the fund's pitch and I think, yeah, that's really interesting. I think the research enhanced indices, we did a podcast on this recently. I think those are the ones which I'd be most likely to go for, which are actively managed, because it's not just one person or a small team which is intensely analysing stocks and trying to work out which ones will be best. It's like an industrial approach where you take all the output of the equity desk of a company like JP Morgan and you combine all of their forecasts, you sort stocks into best to worst, you have quintiles, I think, and then you go long the ones which are at the top, you sell call options which are for the ones at the bottom, so you enhance your income. These are the kind of funds which I think are more likely to work, and the overall fees aren't particularly high. I think it's like I can't remember the exact fees, it varies on the funds, but usually they're around 30 basis points, 0.3%. So those are the things I'd be looking for. Is the alpha, if it exists, sustainable? How is it generated? And could the team change and take the alpha with them? And what's the fee I'm paying for this supposed alpha? Those are the considerations which I have. And I think the one approach which I've found which is most likely to work would be something like research enhanced funds. Now, it's often the case that an active manager will take research from their research team in-house or maybe outsourced in order to generate a fund's ideas, but then they'll add their own gloss on top of it. And then you get all of the cognitive biases that you get with a retail investor. So I don't think I'm going to be falling over myself to do it, though, Mark, to answer your question. Oh no, was Mark? That was Richard Ellis. Anyway, look, let's draw a line under it there. Thank you for joining us, and thank you for your super chats, and thank you for all of the questions. And don't forget our podcast, our membership. So podcast is Many Happy Returns, membership, pensioncraft.com/membership. And that way you get access to all of the tools that you saw me playing around with, and you get access to the chat application so that you can chat to me and other members of the community, and also our huge library of explainers which go back many years and which I've answered member questions about things like excess reportable income and investment. Anyway, thank you all for joining us, and please do like and share. I should have said that right at the beginning, not at the end. And good luck with your portfolios.